talk about oil, because 2 years ago today, the price of crude, US crude, fell to minus $37 a barrel. Today, we are above 100. Who could have predicted it? Joining us on the line with some perspective is the senior energy and geopolitical expert at the University of Oxford, Justin Dargin. Justin, good morning. Thanks for being with us.
Oh, good morning. Thanks for having me.
So let's just rewind a couple of years ago. Where were you? It's one of those moments. Where were you when oil hit minus 37 bucks?
Well, actually, I was trying to get on the last plane out of the UK to get back to the US. Wasn't certain if I was going to make it, but it's just been a wild, wild ride. I mean, initially, what we can say is that this started by the fact that Russia did not agree with Saudi Arabia and also OPEC's decision to try to implement further oil production cuts. And as a result, Russia walked away from the table. Then that's how you actually had the start of this price war at the very start of the pandemic. And then so these two events obviously pushed the oil price down to a very low level. However, one thing that we did see is that throughout this market share competition between Saudi Arabia and Russia, it was mostly Russia that was focused on the U.S. market, because Russia still was, we could say, hurting or smarting from the fact that the Trump administration had placed sanctions on Rosneft in February of 2020. So to a certain degree, Russia wanted to avenge that and want to reduce the ability of the United States to wield, its favorite weapon, which is sanctions. So what Russia was attempting to do was to more or less diminish the power of the U.S. economy through targeting the shale oil sector. I mean, so that's how really we got in this type of position. But then what we saw is that as Russia and Saudi Arabia started to recognize that neither of them would be able to benefit from a continuation of extremely low oil prices, then that's where we saw OPEC Plus come together and form a type of accommodation.
Yeah, so it's hard to believe, isn't it, that 2 years ago, Saudi Arabia and Russia did have a bit of a falling out. It's probably too strong, but a very strong difference of opinion. And yet this weekend, maybe it's no coincidence, we've had Mohammed bin Salman, the Crown Prince in Saudi Arabia, and Vladimir Putin on the phone having a call about OPEC Plus and about oil production. Clearly, lessons have been learned from these major producers, it would seem, Justin.
Oh, absolutely. I mean, we could say that OPEC and Russia have had a symbiotic relationship for decades. And so even if we go back to 1973, which was the oil embargo, Russia actually was able to catapult to one of the world's leading oil and gas producing countries because of that, and because of the price of a barrel of oil increased from about $3 to $12 per barrel. So you saw an influx of just a massive foreign revenue influx into then the Soviet Union's coffers. And then, however, there was also a falling out, we could say, between the Soviet Union and Saudi Arabia when Saudi Arabia increased its production substantially from about 2 million barrels per day to about 10 million barrels per day within a 4-month period in 1986. And many people believe that was actually one of the main, how can we say, points of where the Soviet Union began its slow descent into its final collapse. I mean, so we can see that there has always been a type of love-hate relationship, we could say, between the two countries, just as it relates to oil production, due to the fact that sometimes they have divergent interests in the way that they want to pursue their export policies.
So, minus 37 bucks a barrel a couple of years ago, over $100 a barrel now. Where do you think the sweet spot, the natural equilibrium for oil is? For me, it's about $70 a barrel. And people like my co-host Tom and Brandy tease me because I always say, we're going to be $70 by Christmas, because I believe that's the natural equilibrium that keeps producers happy, and they'll invest enough to invest in new infrastructure, but it's not too high for consumers. But that's just I plucked that number out of the air. For you, where's the natural equilibrium price for oil?
Well, actually, that's quite a fair point. I would say that one thing we do have to consider is the break-even oil prices that many of the OPEC countries have to acquire in order to keep their budgets solvent. I mean, so for instance, if you look at Saudi Arabia, it's over $80 per barrel that it must receive in order for it to continue its budgetary outlays and to remain solvent. And in particular, we have to look at the fact that Saudi Arabia, for instance, and also Russia, they have a lot of massive infrastructure projects that they're attempting to engage in. So if you look at, for instance, Saudi Arabia's Vision 2030. So I would say that in order for many of the oil producing countries to be happy, I would say that the price would actually have to be around $90 per barrel. And of course, in terms of the U.S. shale industry, we're looking about $40 to $50 as the break-even price for them to be able to recoup their operating costs at the same time. So I would say anywhere above $90. And I think we've entered into a new reality now, considering the fact that the world is attempting to decarbonize at the same time. So I think that the era of extremely low oil prices for the foreseeable future is in the past.
Justin, great talking to you. Appreciate your time this morning. Thanks very much for being with us. Justin Dargin, Senior Energy and Geopolitical Expert at the University of Oxford.